We're still going on with the Black Blockchain Summit, seventh annual. And, we've been having great discussions. And, thank you everyone for joining. I'm particularly excited about this coming topic, which I think is very important, especially this year. And, I'm joined by amazing speakers. We have Alex Carmen, who introduced themselves, Della Adeje and Joshua Taylor. And the topic we have today is how to thrive without raising capital in the current crypto environment or in the current fundraising environment in general. So before we dive in, I'm going to leave the floor to the speakers to, introduce themselves, and I'll start with Alex.
Cool. Thanks for the introduction. Excited to be here. I'm Alex Carmen. I live in Brooklyn, New York. I'm currently a partnerships manager at Toast, a hospitality, fintech, and SaaS platform. And I'm also a venture partner at Going VC Partners and also for a few other syndicates. So really excited to be here. Thanks for having me.
Great, great. Joshua?
Yes, of course, definitely excited to be here as well. I live in Houston, Texas, so that's where I'm from. I'm a director at Fifth Star Funds. We're a philanthropic venture fund, giving 25K checks to Black and other discriminated founders, friends, and family around, closing the wealth gap. And also a venture partner at South Loop Ventures, based in Houston. Super excited to be here.
Thank you. Thank you, Joshua and Della.
Yeah, thanks. Super excited to be here as well. Yeah, my name is Della. I'm an investor at Mac Venture Capital. We're a seed stage fund based here in LA, and SF as well, investing in a number of companies at the early stage, but mostly geographically agnostic and sector agnostic as well. And yeah, I've been here for the past 3 years, and yeah, we've been around since 2019 as well. So we're on to our third fund and excited to talk more about what's happening in the ecosystem.
Great, great. Thank you so much. And I'm Tongai Choto. I'm co-founder of AfriBlocks, which is a Pan-African freelancers talent marketplace. And I guess on this panel, I'm on the other side of the table, as I'm a founder, a startup. And so I'll be asking, questions that, us as founders have had, other founders have asked me, I've called other founders as well. And I'll start with Della. And I want to ask about around, most founders, when they start startups, and the next thing is like, I need to raise funding. But it's not always the first route or the first option. There are other options out there, for example, bootstrapping, for example, basically just getting your, using your own funds to get to a point where, you're, seeing some revenue. However, there's some startups or some ideas where you feel like, you're not going to make money for a long time. The reason being, is to try to reach product market fit, or you don't even know how you're going to make money. You're just seeing people are interested in this. So what would be your approach or your advice to someone who's starting today? Like, I have this bright idea. I'm in ideation stage, or I have, some wireframes. How do I take it from here?
Yeah, I think that's a great question. And, I'm fortunate to speak to a lot of entrepreneurs who are at this stage as well, in their cycle of company building. And I think the first, step really in terms of bootstrapping is, of course, ideating on, what the product you are going to build is. I think even before you get to an MVP, it's really understanding, not only who the user base is, but also the customers that you're talking to, and spending as much time with them so you can really tackle the pain point as efficiently as possible. I think now in this, macro environment, bootstrapping has now become the norm in some way, shape, or form. And I think finding ways in which you can exemplify product market fit as not necessarily as soon as possible, but as efficiently as possible is really, sort of the best way to scale your company. And, in some cases, venture capital isn't necessary for a lot of different businesses. You see a lot of companies that have been able to bootstrap and become successful without the need for raising money. And dependency on venture capital, it has become sort of the norm the past few years, but it doesn't necessarily need to be the end all be all. So yeah.
Got you. And I think the interesting thing is when everyone starts a company, a startup, and they always see the Silicon Valley type story where, you meet at a bar, you meet a founder, then you meet one of your friends, you start a company, you're funded before the year ends, and Series A, Series B, like that's what every founder thinks is going to happen, but it does not. So my question to Joshua is around how people should look at your bootstrapping, you're getting some revenue, using your cash flow to stay afloat while you get to that MVP. You move on from MVP to product market fit. How best can founders use their cash flow basically to have a longer runway before they even think about raising?
Yeah, that's a great question.
Or should they raise, how would best should they approach
Yeah.
it?
Yeah. Jella had a great point that, a lot of people do not need venture capital right away or at all. Approximately 70% or more of the 5,000 Inc. fastest growing companies are not venture backed. And so we think about that, as Della said again, there's been a saturation of venture capital desire, but a lot of the ideas that people are coming up with aren't venture scalable. And so I think about the problem sets that you're trying to solve is very important. And if you could try to find ideas in markets that are growing very quickly, but also massive, not just TAMs, but serviceable, obtainable markets that are over $1 billion usually, I think that gets investors, all of us on the call, a lot more excited to dive in and potentially help you raise earlier, right? Rather than having the bootstrap and raise later. I think I learned from an elder guy. He didn't raise VC, but he said, he goes to my church and he was like, you should have at least 12 to 18 months of savings if you want to start a company. I think, because it's going to take longer than you think to get your customers to pay you, unless you just have a burning problem that people need to pay for today. But like you said, most people don't understand, they don't know how their business model yet, or like who their ICP really is. And so I think a lot of founders as well don't have that savings. So I think you really need to think about that. And then I guess we could talk about like other creative ways because everyone doesn't have 12 to 18 months of saving, but they have an idea that they want to start now and they have to seize the opportunity. So that's a different type of case.
Got you. And I think gets me to the next question, to Alex. How did we get here? Because we had a point where there was, I think I saw there were like $5 million pre-seed rounds. I was like, how is this going on? And there was a point where, a pre-seed was, 200K, maybe $1 million. And then there was just, particularly into 2022, there was, a lot of funding. Even when you look at the funding in Africa, that was one of the highest years. And then 2023 was down, 2024 is down. So how did we get here? Is it sort of a VC correction, market correction? Like, how did we get here?
I think exactly what you're saying. It's a bit of a correction. I think if we look kind of before, a lot of the companies that grew and some of their growth was probably subsidized by VC. It wasn't really truly a reflection of their market, like their margins and their success rate. And I think that like if you look at time-wise, there's a lot of layoffs, and probably the layoffs was looking back on, okay, did we need to scale our sales team like 10x where we were? Did we need to expand to a new market, or was there still growth and opportunity where we were? And I think, as mentioned, that having that kind of consistent assessment with your business, what your goals are, and that helps grow in a sustainable way. So I do think that we're in this position. It's a bit of a correction. I feel for founders, I feel for the market. I think that it's been a slowdown, but it is a correction. And I think it also is going to have us look back on what business models should be venture backed, and then what is the amount that is feasible and makes sense for where they are. Are you raising for technology? Is there significant investment you need in developers? Or are you really solid with your MVP and now you're able to grow and to, look more at, okay, our sales. So I think that there's been a correction. I think it's been really exorbitant over the last few years. So it's painful. I know a lot of companies have struggled, but I do think it's going to make us more thoughtful in how we move forward.
Got you. And I think that the interesting thing is around, people have raised, multiple rounds before, and then a lot of startups have failed after raising a lot of money. And then that's when people started to go back and try to think okay, were they supposed to get the money, in the first place? In this being the Black Blockchain Summit, Alex, I want to ask, is funding still available or still being availed, particularly to Black founders and Black startups, in your opinion?
Yeah, I'd say funding in general has, I'd say not as much as it was. And I also think VCs are having more of a critical eye, and maybe some of the how much you're writing and how many checks. I think if you look at numbers, the amount of checks have gone down. And then if you look at that, if the number of checks is going down, Black founders are already at a really low percentage of VC funding. So we're this community is going to feel it the most. And I think it's really great that we're having this conversation on how to be successful without it, because I'm here with peers that we love to write checks to Black founders, but that's not always the consensus across all. And I just say in general, the amount of checks are going out less. So the more you could be lean, I think we're all have to be resources, but just to be candid on the environment, I think it's a tough market to raise.
Got you. And when we were speaking to Joshua, I think he mentioned what you do at your fund. So I wanted to ask around the alternative capital sources like grants. We've seen community driven raising, what do you call this? Crowdfunding as well. So Joshua, is that still an alternative for founders, particularly grants and crowdfunding, and revenue-based financing, or it's a no-go area as well currently?
Yeah. Great question for the different options, right? I think number one, especially within blockchain, there's you have the community-based financing through, I know token sales, popularity has gone down, but I think there's power. If you can create a true community that's truly involved in the project, then you can let go of some of that equity, because there's still a lot of token-based funds out there that take token equity. But I think it's giving some of that leverage up to your community as well, and having a precise tokenomic structure. I think that's a lot of the problems we had in 2021 in the last bull run, was that people didn't really understand tokenomics. They didn't understand those structures. And that got people in a lot of trouble legally as well. Especially a lot of the VCs were just being traders essentially, and liquidating on consumers. That's a whole nother story though. I think also with startups, I think revenue financing, based financing is like for, I would say, larger companies, but it's still something that I think is leverageable. But I think you got to be careful with that, because if you're trying to build a scalable company, you don't want to be throwing away or like giving away some of your revenue early in that process. I think even depending on your credit, like your credit and how your net worth is and things of that nature, like getting a loan is good as well. Of course, you have to pay that back, but I think, depending on what you're building, could help as well, because you want to keep the equity in your pocket, right? Um,
Yeah.
but I really think that the best way, in my opinion, is to bootstrap. I know that isn't, like I said, isn't for everybody, but I just want founders to be able to keep the equity in their hands so they can control the vision of the company for as long as possible.
Got you, got you. And I think you brought something interesting with the I'll say the ICOs, and they started, the ICOs now, it's more, structured. But to Dela, is it something that founders still come to you with, we have a token sale, a private sale, or it's now I know obviously it's less, but are you seeing some people that come with, solid plans that you think might actually work? Or I know some of it, would be scammy. We have seen a lot of people raise a lot of money, and uh, you know, a lot of investors lose their money because, it was just a scam. So I know most investors don't want to be involved in that. But I think with every technology, like, with when the dot-com bubble burst, and they still came out a lot of good startups out of that bubble. So is it something that we can see, or we might see in the near future, where token sales are still a vehicle for startups and founders to raise money and actually build successful companies?
Yeah, great question. At Mac, we've seen a number of companies that have come and pitched to us, and have used token sales as part of their sort of pitching strategy as well, to maybe incentivize VCs as well. Also, and we don't invest we typically don't invest in any blockchain or Web3 companies that are have a token sale incentive. We typically try and stay away from that. I think for us, the biggest thing that we like to focus on is the fundamentals of the business, right? If you have to sort of be dependent on token sales to really scale and provide value to the ecosystem, it may be relevant to another fund that may be incentivized by that. But for us, we are focused on what's happening in the business, and how does it benefit the ecosystem as a whole, either through any of the businesses that they're selling or building for, or any of the consumers or developers in that case that they're building or selling to. So I think that's the way we like to think about it. Of course, there's more regulation coming in this era, and I think skepticism around what tokenomics look like will definitely evolve and change. And I'm sure us as a fund will have to, rethink our strategy here. But at the end of the day, investing in startups is about investing in, the founders who are building companies that will, experience some form of hypergrowth scale, and are building, these businesses that fundamentally will enable them to again be accessible to the ecosystem of players that they're building for at the end of the day. So yeah.
Got you. And I think one question that might be beneficial to our listeners, which might seem super basic, but I think is in this case will be helpful, Della, is what is a venture backable company or startup? Because I've seen, some car companies coming out, and I'm like, is this really I don't know. It's just a car company, but they're portrayed as a venture backable, venture. So, to the benefit of our for our listeners, what is and how do you determine that my idea is venture backable?
Yeah. I mean, I think that's a great question. I also think it depends on preference of the fund. I think at the core, what a venture backable startup is a technology company that again will scale with venture capital funding in typically 5 to 7 years, to which a VC can expect a return on that investment. I'd say 5 to 7 years in the near term, typically 7 to 10 traditionally. And what that looks like, right? You're seeing a number of different companies being funded, whether that's again blockchain companies in the ecosystem, or whether that's consumer packaged goods, another water bottle, or a another enterprise software company. For us, the way we think about venture backable, startups, it's how are they going to make money in an efficient way, and how are they going to scale the business as well in an efficient way. So, different business models that we typically like to look at are, of course, the traditional, SaaS business models that we see. So, companies that are selling these existing services to other software companies or other consumers or businesses. There's some form of maybe reoccurring revenue that exists that we can sort of predict, hey, because you've been able to generate revenue at this point, in the future, based off of this amount of customers, you can generate, you can increase revenue significantly by that point. So I think that's really how we like to think about, venture backable startups. But again, a lot of times you're seeing companies that, weren't traditionally venture backable become venture backable as a result of the market. So, defense companies like an Anduril or, a SpaceX in a way, traditionally weren't venture backable companies and are now considered a venture backable company because of the category that has exploded over recent years. So, yeah, a lot of it is based on what the market perceives. But the goal as a VC is, of course, to be ahead of the market and be proactive rather than reactionary. So, time will tell.
Yeah, I think the biggest, lesson that you've taught me there is the market is always changing. So I think it's easy for people to think that it always changes on the founder side, but it also changes on the venture side. Like, they see new things, they see new markets, new products. Like right now, how it is with AI and, a lot of money going in there. So the next question I had was to Joshua around scale. So Adela, mentioned that scale is one of the things that, VCs look at in terms of is this venture backable. So how do you manage that? Because when VCs come, what they want to see is scale. Like,
Mm-hmm.
is this growing, or does it at least have potential to grow at some point? So now you are a founder, you're bootstrapping, and you need more money to scale, but then
Mm-hmm.
you don't have. So how do you strike that balance? And in some cases, maybe you've raised a pre-seed, but then you want to increase your runway so that you get to product market fit. But to get a product market fit, you need to pour in some money. Like, how do you manage
Yeah,
that?
yeah, I can answer that. Great question. You're killing it with the questions. But I think you have to go back to what is really product market fit. I think there's stages of product market fit, because where we invest all here on the call with, at the pre-seed seed level, we may have follow-on capital for A, but you're showing signs of product market fit at the early stages. At the pre-seed, maybe you have some contracts that are letter of intent, they're about to get signed. Maybe at the seed round, you're close to $1 million in annual recurring revenue, depending on your business model. And you're having certain growth targets on a quarterly basis. So it also depends on the business as well. Like if it's a marketplace, you need to be growing at a certain percentage on a quarterly basis, right? If you're a enterprise SaaS business, you need to be growing and compounding. I think founders say, oh, I got product market fit, I need to scale, but like they're not growing on a monthly and quarterly basis fast enough, right? They're not doubling, right? I think the adage you guys could get me, it's like triple, triple, double, double on an annual basis. Like if you don't triple your business the first 2 years, like you're like after getting funded, it's like it's really hard to come back for that. That's just the VC math, right? So I think early in your business, once you find your core customer you can go deep in, it's like, can I go on a vacation over the weekend and my company's for a week and my company's still growing, right? Of course, you might have a small team and you like need to answer customer calls and like be in the trenches. But I think it's like, you want to get to that point where the faucet is just going. And it's like, dude, we're going to flood the sink if we don't stop doing this. That's real signs of product market fit. And I think founders jump the gun because they have a couple customers and they're like, oh my God, I got it. Which it's a hard balancing act because you want to show investors like, I got this big pipeline or all these consumers are coming in the door. But like Della said, are they paying, right? What's that efficient growth? Because it has to keep going, right? We invest in, at least at the seed stage, I would say, is growth. We're the fire hose. We want to spray, right? So if you didn't have it, you would still be growing, but we're in a race versus other competitors. So what you saw in 2021 is a lot of reasons why that was happening, but also when COVID broke us open, there's all this free cash for little interest rates, right? There's just a lot of cash for people to run in these new markets. So they're going to be a little more slothful. Right now, cost of capital is higher. We're going to be a little more prudent. So we need to make sure as founders that we're able to really have our unit economics right? And also those continual customers coming in, and be honest with yourself that, yes, I am compounding at this rate per month, at this rate per quarter. And because that's what we're going to look for is that those growth metrics. So.
Got you. Thank you so much, for clarifying that. I think to Alex, the question that I have is, we've talked about. I think Della mentioned, 5 to 7 years as a period that a VC looks at retaining their money and things like that. Is there a position or some companies or some startups that would take longer? Be it in the current market being one of the factors, also being just, an industry that's difficult to penetrate. I think if you start to say, a ride-hailing company, it's probably going to be difficult for you it's probably not going to be a year, it's probably going to be 2 years before, you break into the market. I think here in Zim, there's a platform called InDrive, and it has managed to penetrate the market. And the reason is they're saying you negotiate your fees, right? Basically, as opposed to when you're using Uber, the fee is $5 or $10. That's it. But in this case, you negotiate your fee with your driver. So that's how they've managed to do it. But reading their story, it took them a while for them to figure that out. So the question that I have is, do VCs also consider that, or should startups and founders, because you reach a point where you're like, okay, it's been a while, am I going to break this market? How do you balance out that as a founder, as always a VC, to say, okay, this is going to reach that product market fit, but it's just going to take longer?
Yeah, I think that's a really good question. And it is a bit of a balancing act, like exactly what Joshua mentioned. You do want to see compounding, growth, but there's so many factors. And also, like you mentioned, industry. So like healthcare is a highly regulated industry, finance as well. So those I'd say when you start to look at those industries, you're looking for like a certain level of compliance and like you're almost like building into the industry, but also understanding that those are just, there's going to be some timing on that. The other aspect I'd say is I think it's really important to build out financial models in your pitch deck, because then it shows how it's like it's your opportunity to say, this is my point of view on our growth in the market. And of course, though, there's some back and forth on models. I think everyone has different opinions on them, but I think that's the fun part of it, where you're saying, okay, we're accounting for, this is where we are today. And based on these projections, this is the amount of growth we're expecting over the next year, over 5 years, 10 years. But just as mentioned, as Della mentioned, like, the market is always changing. And I think that there's the being able to pivot is really important. And I think that that's something that cannot be emphasized enough, is like, VCs, we need to be thinking innovatively, as well as founders, and understanding, okay, are we going in the right direction? Like, maybe our product market fit, like, it's not landing in this area, but we're seeing some other opportunity, being able to make quick decisions, but also data-driven decisions. I think that's something that's really important, being able to back your gut with data to support. And the other thing is, like, so that's marketing, but also like your financial model. So I think think of those are levers that you have, that you can tweak to tell the story that you want. But I think, in short, to answer your question on like the timing, I think these are like averages that we're looking at. So like 5 to 7, that would be great. I don't see those often. And I think 10 is probably, like, on average, what you'd say is kind of a route to exit. But there's others. And I think also kind of your funding strategy is going to influence that. Like, if you might have had like a lengthy friends and family, are really, it's long pre-seed. So those are going to factor in. I think that what you're asking for in the growth is like very important. But yeah, there's a lot of factors, all that to say. So I think mostly being able to tackle your story is really important.
Got you. And I think it just reminded me around AI and how people and founders are just throwing it in each and every deck. It's the AI of this, using AI for this. So to Alex, how are you, or the market as founders, how is VCs looking at AI products? Because I've seen a lot, and some of them I'm like, okay, this is just ChatGPT, It's
I
so
I agree.
yeah. So what would be your advice to founders to say, if you're building in AI? I think AI is, pretty interesting. It's a great industry, but there's that thing, like I mentioned, just putting, a backend to API to ChatGPT and responses, and then it's not really helpful because it's not that sophisticated, since it's just getting from ChatGPT. So yeah, what are VCs thinking around it, and what would be your advice to founders? Because there are some founders that would really be building in AI, but is it a throw off, a put off when, you just see AI on someone's deck?
I won't say it's a put off, but I think it's very important to be very specific about what aspect is AI. And also, there's, my background is in data analytics. So there's like kind of basic data analysis, business intelligence. You kind of get into machine learning, then AI. Like, there's a lot in between there. And not everyone is actually doing AI, nor should everyone be doing AI. Like, if there's technology that you could tap into, I think you should leverage it. But I think it's become a marketing term, and it's really important to be transparent. It's like, okay, are you building models? Are you like, I forget what the term is on kind of a MLM, or I think I'm missing
LLM.
LLM. There you go.
Model.
Yes,
Yeah.
thank you. So like, those are some of the attributes that you want to see. But then again, I think it's important, like, does it actually make sense to be doing that? Because that's also a lot to manage, a lot of data that you have to be taking advantage of. And maybe, like, sometimes it makes sense to just say, we're leveraging machine learning, like, we're learning as we go. It doesn't have to be AI.
Yeah. Yeah. And the same question, to Joshua, but in this case around Web3, because there was a point where also people were saying Web3 of this, we're using Web3, we're using blockchain, but I think the major difference that I like about blockchain is it's a technology, it's a protocol that people can literally actually use. It's open source. I know in AI, there are also some open source models and everything, but blockchain is I'll say more mature, since, it has been there for like over 10 years now. But I think most founders as well as VCs had moved away from it, for multiple reasons. But going back to what I mentioned about the internet, where it was a bubble, it popped, and then they still came out some great companies out of it. So in this case, I think the people that were in there for the volatility and making money out of Bitcoin and things like that, uh, some of them have left, but now there's still some founders, which some are builders, which is why we have the Black Blockchain Summit. What are your thoughts and advice to people building in Web3 as they approach VCs? I think it's also important to approach the right VCs. In Web3, so approach the right VC who says, we're investing in Web3. But at the same time, what's the best way that won't make you seem like, you just, I guess, by using buzzwords in your deck or something like that?
Yeah, I think web, I want to answer succinctly. We only have 2 minutes. So Web3 is all about the change of the stack of the internet. So blockchain is a fundamental layer of the internet. It's not just a buzzword where we're going to use this community to leverage a coin and all the things that were happening that people really didn't understand what they were talking about. And so really the blockchain is really just an account ledger and a validation tool for your software stack. So the information you're putting in, it's validating it on both sides. And it's rejecting double counting, at least on the finance side. And so on double spending. And so really from that page, there's trillions and trillions of dollars that flow every day across the world, right? Not just from a currency perspective, but from many different forms. And I know that there's been 63 companies that have raised over $1 million or more in Web3 this month, in the month of August. If you go to crypto-fundraising.info, it's all there, all the funds. There's still hundreds of funds that are investing in Web3. I think blockchain is here to stay as a layer of the stack, just as artificial intelligence is just changing the way we do the internet and how we perceive information and get that information and spit it out. And so blockchain is just going to be a part of the internet and how it's run and how it's validated, whether it's a closed private chain or if it's a public chain. So definitely a lot of potential and a lot of problems that still need to be solved in the space.
Thank you. So this has been a great conversation, and unfortunately, we're out of time. However, I'll leave the floor to our speakers to give us their last or final thoughts. I know I've been driving the conversation, but anything else that might be super helpful to our audience. I'll start with Dela.
Yeah. Oh my gosh. Putting me on the spot. Yeah, I think my one piece of advice is, to keep going. I think especially in this environment where things are, difficult, volatile, no one really has any sense of what's going to happen in the future, particularly around, markets. And with this upcoming election, people are, very nervous around what volatility in crypto will look like as well. So, all to say, if you are, if you continue to persevere and are consistent and disciplined in what you are building, continuing to solve, a pain point for your user or for your customer at the end of the day, then I think with that will essentially allow you to be resilient when things are going well. right? So I think this is the perfect time to, start a company and really build the foundation to better those fundamentals. I talk to, a number of different African founders daily who are, wondering why isn't there any influx of capital coming into the continent as there was, 2 years ago. And, I tell them the same thing. Building now will be harder than ever, but in the future, you'll be better for it. So all to say, keep going. Simple as that.
Great. Thank you, Alex.
Yeah, that was great advice. I think I'll give some perspective on, like, since it's the Black Blockchain Summit, on like why I still have conviction in blockchain despite all the noise around it lately. But so I was at IBM in 2015, and that was around like the IBM Watson, and Watson was like it was tanking. It was not getting a lot of good rep. AI was like this fake iRobot idea at the time. And now we're in 2014, so that's almost 10 years. And now we're seeing like the promise of AI. We're starting to, I'd say we're not quite there, but we're starting to see like line of sight to it. So all I have to say is, if you're building now in blockchain, like, time-wise, we were just talking about, think about 10 years, like what we can be. There's still a lot of opportunity. And even though it's a tough market, and it was with AI, and probably in the last few years, like once it became more, I think, user-friendly for individuals, that's when the whole AI conversation picked back up. So I am still bullish in blockchain and think that we have that kind of trajectory.
Thank you so much, Joshua.
Della and Alex killed it already. But I think I definitely agree that all our money will be on chain in the future. It just takes a while to change the infrastructure. I think that, like Della said, it's a great time to be building, the best time to be building. I think really challenge yourselves as founders to question, are you ready to sacrifice 10 years of your life to build a generational company? Because that's what we're looking for in venture, is massive returns. But I think about if you're that person, and what that person is going to make you become, because that decade of your life is going to be insurmountable. It's going to be one of the hardest things you ever do, but maybe one of the most fulfilling things that you do. So just really think about that, and that's what you really want. And that's what's really a part of your purpose.
Thank you. And I love that, the advice, and it's also super helpful to me, to keep going. And I would add to all founders or entrepreneurs, it's hard. So take care of yourselves, take care of your families, put your mental health. It's something that people don't talk about much, but take care of yourself, take care of your mental health, and keep building. Thank you so much to our speakers for taking their time out to share their knowledge with all of us. And on to the next session. Thank you, guys.